Your brain is literally addicted to losing money, not metaphorically, not psychologically, neurologically addicted. MIT neuroscientists just proved what Wall Street has hidden for decades. The prospect of newfound riches triggers a surge in dopamine levels, generating excitement and pleasure, the exact same neural pathway as cocaine. But here's the plot twist that will change how you trade forever. The most successful traders on Wall Street, they have a genetic mutation. Two genetic alleles that affect dopamine are associated with success at trading stocks on Wall Street. They're not smarter, they're not luckier. Their brains are wired differently for one thing: moderate dopamine. Not high, not low, perfectly balanced. Welcome to Trading Psychology Stick, where we rewire your brain, not just your trades. Disclaimer: educational only, not financial advice. Trading is risky. Always do your own research. Before we dive deeper, I need you to do something. Look at your last month of trades. What percentage were losses? If it's above 30%, what you're about to learn could save your account. Comment below with just the number. No judgment, just data. The shocking reality check: 72% of day traders ended the year with financial losses, according to FINRA. About 70 to 80% of retail traders lose money. Only 1% succeed beyond 5 years. But here's what nobody tells you. It's not about eliminating greed. It's about redirecting it. In the next 50 minutes, you'll discover the 15 neural rewiring techniques that transform toxic greed into what I call strategic greed, the same mental framework used by the 1% who consistently profit. This isn't motivational fluff. This is hard neuroscience meets real trading data. These insights come from Stanford and MIT brain imaging studies on actual traders, analysis of 10,000 plus retail trading accounts, classified Wall Street genetic research, and my personal journey from blowing 3 accounts to managing 8 figures. What if I told you that your greed isn't the enemy? What if the very emotion destroying your account could become your greatest asset? What if the difference between the 90% who fail and the 10% who succeed is simply where they point their greed? By the end of this video, you'll never look at a chart the same way. You'll understand why every loss you've taken was neurologically predictable. And most importantly, you'll have a scientific blueprint to rewire your brain for consistent profits. From a neurochemical point of view, winning can have the same effect as an illegal substance. Your brain is already changing just from watching successful traders. The question is, will you let it change randomly, or will you take control? The clock starts now. Your transformation begins with understanding the first neural secret. You're about to discover why you keep making the same trading mistakes. These first 5 insights will make you realize you have a problem. More importantly, you'll understand it's not your fault. It's your biology. Insight number 1, the biological trading clock. Your brain becomes a financial predator at 3 specific times every day, hunting for the worst possible trades. Your greed isn't random. It follows a biological schedule as predictable as sunrise. Scientists discovered 3 critical periods when traders' brains betray them: the cortisol crash at 4 a.m., the sugar collapse at 2 p.m., and the loneliness loop from midnight to 2 a.m. During these windows, your ability to assess risk drops by up to 70%. Let me tell you about the London whale. Not the headlines you read, but what actually happened in those trading rooms. Bruno Ixel, the trader who lost JP Morgan $6.2 billion, had a pattern nobody talked about. Internal records showed 73% of his position increases happened during 2 windows, 4 to 5 a.m. London time and 2 to 3 p.m. 4 a.m. London, Ixel's at his desk. The cortisol that should protect him from bad decisions, at its daily minimum. His brain interprets this depletion as calmness, clear thinking, but it's the opposite. It's vulnerability. He sees the futures moving. His depleted brain can't differentiate between opportunity and noise. He adds to his position, then adds again. Each addition feels rational in his cortisol-starved state. By the time New York opens and his cortisol normalizes, he's built a position so large it would take months to unwind. But here's the kicker. He did this pattern for 180 days straight. Same times. Same biological blindness. The 2 p.m. phenomenon was equally destructive. Post-lunch, blood sugar crashes. The brain seeks stimulation. For a derivatives trader, that stimulation comes from one place: bigger positions. Quick test for you. Pull up your trading history right now. Seriously, do it. Look at your biggest losses. What time did they occur? I'm betting over half happened at 4 a.m., 2 p.m., or midnight. CME data backs this up. The 4 a.m. hour has 400% more retail losses than any other period. It's not the market. It's the mismatch between human biology and market hours. Mike Bellafiore from SMB Capital documented this with his traders. One consistently profitable trader became consistently unprofitable just by taking the London session. Same strategy, same setups, different biological state. His solution? He now trades only 9:30 a.m. to 11:30 a.m. New York time. His win rate jumped from 35% to 67%. Nothing changed except respecting his biological prime time. The professionals don't fight biology, they map it. They know their danger zones and either avoid them completely or use predetermined automated strategies during these periods. Track your losses for a month. What time did they occur? You'll likely find a pattern that matches your biological rhythm. Are you trying to be a hero by trading when your brain is the villain? What if you only traded during your biological prime time? What if respecting your neural limitations was the edge you've been searching for? Your 24-hour challenge. Tomorrow, mark your danger zones. Red blocks on your calendar. Don't trade during them. Just once. See what happens. But biological timing is just the beginning. The next trap is even more seductive because it happens when you're winning. Insight number 2, the winner's curse phenomenon. Your biggest win is statistically your most dangerous moment as a trader. Imagine your brain as a nightclub and dopamine as the DJ. When you hit a big win, that DJ cranks the volume to 11. The prospect of newfound riches triggers a surge in dopamine levels, generating excitement and pleasure. The party is incredible for about 72 hours. Then comes the crash nobody warns you about. Jesse Livermore knew this pattern intimately. The man who made $100 million in 1929, equivalent to $1.5 billion today, also went bankrupt 4 times. Each bankruptcy followed the same pattern: massive win, dopamine flood, reckless decisions, total destruction. His journals, studied by behavioral economists, reveal the cycle. After shorting the 1929 crash successfully, he wrote, "I feel invincible, like the market speaks directly to me." Within 90 days, he'd given back 90% of his profits. But the modern version is even more brutal. Remember GameStop? January 2021, a software engineer posted his $5,000 to $150,000 transformation on Reddit. 3 days, 2,900% return. The screenshots went viral. His brain was experiencing a dopamine surge scientifically measured to exceed winning the lottery. His Reddit posts tell the story. Day 1 after the win. I've cracked the code. Matrix vision activated. Day 3. Putting everything into the next play. Why settle for $150K when I can hit $1 million? Day 7. YOLO'd into 5 different meme stocks. Day 21, account at 0. His final post was haunting. I don't understand. I felt smarter than ever. Every trade looked perfect. That's the curse. He wasn't seeing clearly. He was seeing through dopamine goggles. Every setup looked amazing because his brain needed more action to maintain the high. Pause the video for 10 seconds. Think about your biggest win ever. What happened in the next 30 days? Type yes. If that account eventually blew up, you're about to understand why. Brain scans from Northwestern University show winners' dopamine receptors literally burn out, like speakers pushed too hard. What happens next is predictable. You need bigger trades, bigger risks, bigger wins just to feel normal again. 73% of accounts blow up within 30 days of their biggest win. It's not karma, it's chemistry. The professionals know this. Ray Dalio's Bridgewater has mandatory cooling-off protocols. Win more than 5% in a day, you're done. Computer locks you out, not as punishment, as protection. Paul Tudor Jones goes further. His best days are followed by his smallest position sizes. I trade inverse to my confidence, he says. When I feel like a genius, I trade like an idiot. Small, careful, suspicious of my own brain. Think back to your biggest winning streak. Remember that feeling of invincibility? The voice saying you finally figured it out? That wasn't confidence. That was your brain on dopamine overdose. What if your best trades happened not when you felt like a genius, but when you felt neutral? What if the secret to consistent profits was treating big wins like dangerous drugs? Amazing in small doses, deadly in large ones. The winner's curse is powerful, but at least it's obvious. The next trap is so subtle, most traders don't even know it exists. Insight number 3, the reality distortion field. Every profit screenshot you see literally damages your brain's ability to assess reality. Then your own floating profits finish the job. Two forces combine to create what I call the reality distortion field. External social proof warps your expectations. Internal phantom profits warp your perception. Together, they create a hallucination more powerful than any drug. Long-term capital management proved this on a massive scale. Nobel Prize winners, literal geniuses, 40% annual returns. Their reality distortion was so complete, they leveraged 250 to 1. John Merriweather, LTCM's founder, later admitted, "We stopped seeing risk. We only saw our models, our returns, our reputation. Reality became whatever confirmed our genius." But here's what happened in their offices, according to employees. The partners would start each day reviewing their positions. Up 10 million, up 50 million, up 100 million. These weren't realized gains, just numbers on screens. But their brains didn't distinguish. They'd spend phantom profits in their minds. New houses, philanthropy, legacy building. The unrealized gains became more real than reality. Then came social proof. Every financial magazine featuring them. Every competitor copying them. Every investor begging to give them money. The external validation made their internal delusion feel like truth. August 1998. Russia defaults. Their positions move against them. But they can't see risk anymore. They see temporary setbacks. Buy more. Leverage more. Reality will bend to their will. It didn't. $4.6 billion lost in 4 weeks. The Fed had to coordinate a bailout to prevent global collapse. These weren't idiots. They were victims of reality distortion at industrial scale. But it happens to retail traders every day. During the 2021 crypto bull run, I watched it destroy thousands. A trader sees Shiba Inu moonshots on Twitter. 1,000 to 1 million in days. His brain accepts this as normal, possible, expected even. He buys. Price goes up, unrealized profit, $10,000. His brain immediately owns this money, spends it, depends on it. Price pulls back to 8,000 profit. He hasn't lost anything. But his brain screams theft. Someone stole $2,000. He checks Twitter, more screenshots, more millions. His 8,000 feels like poverty. The combination of phantom loss and social proof creates unbearable pressure. He doubles his position, then triples it, not from analysis, from distortion. He's not trading reality anymore, he's trading the hallucination. Comment below. How many times have you held a winner too long after seeing someone else's bigger profits? How often has social media turned your winning trade into a feeling of failure? Research with 807 experienced traders proved the danger. Investors presented with upward social comparison take more risk, trade more actively, and report significantly lower satisfaction with their own performance. Your brain treats unrealized gains as real money. Loss aversion makes every pullback feel like theft. Add social proof showing bigger wins, and you get a cocktail of delusion. The cure is brutal but simple. Hide your P and L. Unfollow profit screenshots. Judge trades only by process, not by the highest point they reached. Reality distortion warps your judgment, but at least it's visible. The next trap is so gradual, you won't notice until it's too late. Insight number 4, the lot size creep. Your position size doubles every 60 days, and you don't even notice. Average position size increases 400% in the 60 days before account destruction. This isn't sudden gambling, it's gradual normalization. Your brain adapts to risk like eyes adapt to darkness, slowly, then all at once. 2 stories, same pattern, different zeros. First, Nick Leeson, started as a clerk at Barings Bank, worked his way to trader. His destruction of the 233-year-old bank didn't begin with massive bets. It began with one small unauthorized trade. Internal records revealed during the investigation show the progression. Month 1, hides a £20,000 loss. Manageable. Month 2, unauthorized trades reach £200,000. Still recoverable. Month 6, £10 million. Brain completely normalized. Month 14, £827 million, twice the bank's capital. Leeson later wrote, "Each increase felt small compared to the last size. My brain couldn't see the absolute madness anymore." Second story, Jérôme Kerviel at Société Générale started with a €100,000 position he wasn't supposed to take. It worked. The dopamine hit was real. The progression was documented in court. Week 1, €100,000. Week 4, €1 million, just 10x. Reasonable, his brain said. Week 12, €30 million, another small multiple. Week 50, €50 billion, larger than the bank's market cap. His manager testified, "If you showed me the 50 billion position on day 1, I'd call security. But we got there one step at a time. Each step felt normal." But this isn't just about rogue traders. It's about you. Pull up your trading history right now. Compare your average position size from 6 months ago to today. Don't look at percent ages. Look at actual dollar amounts. Type guilty if they've more than doubled. The mechanism is always the same. You start disciplined. 0.01 lots. Proper risk management. But wins make you comfortable. Comfortable becomes confident. Confident becomes reckless. Week 2, just this once becomes 0.02 lots. Month 2, 0.05 is the new normal. Month 3, 1.0 lots on high conviction trades. Month 4, margin call. Your brain has a feature called hedonic adaptation. It's why millionaires don't feel rich and why your new car excitement fades. The same mechanism makes yesterday's big position feel small today. The only defense is external controls, hard stops on position size, maximum daily risk that can't be overridden, software that prevents you from increasing size without a cooling off period. Successful traders don't trust their future selves. They know their brains will betray them. They use technology to enforce the discipline their minds will abandon. What if you hard-coded your position sizes? What if increasing size required a 48-hour waiting period? What if you protected yourself from yourself? Position size creep happens slowly. The next trap happens in exactly 90 seconds. Insight number 5. The revenge trading cascade. You have exactly 90 seconds after a loss before your brain declares war on your account. Victor Niederhofer learned this the hard way, twice. The legendary trader who turned 40,000 into 20 million had one fatal flaw. He couldn't accept losses. October 27, 1997. Niederhofer is short puts on the S&P. The market gaps down. His losses hit 50 million, more than he has. Here's what happened in those crucial 90 seconds, according to his own account. Seconds 1 to 30. Disbelief. This can't be happening. The market will bounce. Seconds 31 to 60. Rage building. The market is wrong, manipulated, rigged against me. Seconds 61 to 90. The transformation. Rational, Victor dies. Revenge, Victor emerges. He could have closed, taken the loss, lived to trade another day. Instead, he doubled down, then tripled, fighting the market like it was a personal enemy. By minute 15, he'd turned a survivable loss into complete destruction. Wiped out. Zero. The man who'd beaten the market for 20 years, destroyed in 15 minutes of revenge. But here's the kicker. He rebuilt, made it all back. Then in 2007, the exact same pattern. Loss, 90 seconds, revenge, zero. He later wrote, "Both times I knew within 90 seconds I was about to do something stupid. But I couldn't stop myself. It was like watching someone else trade my account. Set a timer right now. 90 seconds. That's how long you have after your next loss before your brain becomes your enemy. Screenshot this and save it." Neuroscience shows after a loss, rational thought decreases 70% within 90 seconds. Your prefrontal cortex, the CEO, goes offline. What remains is a wounded animal seeking vengeance. Low dopamine levels during the ensuing bust may have led to heightened risk aversion, causing some investors to miss subsequent lucrative opportunities. But that's just phase 1. Phase 2 is worse. Your depleted dopamine creates desperation that manifests as revenge. The cascade is predictable. Loss occurs. Brain personalizes it. The market took my money identity threat. I'm not a loser. Revenge fantasy. I'll get it back right now. Account destruction. Professional traders have mandatory loss protocols. Paul Tudor Jones. After any loss over 2%, I'm done for the day. Period. Computer locks me out. Ray Dalio goes further. Loss equals reflection time, not trading time. 1 hour minimum before I can even look at a chart again. They understand something crucial. Future you, 90 seconds after a loss, is your worst enemy. That person will destroy everything current you has built. When was your last revenge trade? Can you identify the exact second rational you died? Type the number of revenge trades you've taken this month. No judgment, just awareness. What if you had an accountability partner whose only job was to call you 60 seconds after any loss? What if those 90 seconds were protected by systems, not willpower? These 5 insights have shown you the problem. You're fighting biology, chemistry, and psychology with nothing but hope. Now let's dive deeper into why your brain betrays you. Now you know you have a problem. These next 5 insights will reveal why your brain is wired for trading failure. More importantly, you'll discover that some traders have found ways to hack their biology. Insight number 6, the dopamine trading genetics. Wall Street's dirty secret: the best traders are genetic mutants. 2 genetic alleles that affect dopamine are associated with success at trading stocks on Wall Street. This isn't inspiration, it's biology. Successful traders don't have more discipline, they have different DNA. The study was buried for years. 2008, Manhattan. Neuroscientists arrive at a major trading firm, not to study strategies, to study spit. 60 professional traders, all profitable for at least 5 years, provide DNA samples. The control group, 54 MBA students, smart, ambitious, but not traders. The results changed everything we thought we knew about trading success. The traders shared specific genetic markers. The COMT gene, MET158 variant. The DRD4 gene, 7 repeat allele. These aren't intelligence genes, they're dopamine regulation genes. Traders with the warrior COMT gene variant process dopamine 40% slower. When markets spike, when volatility explodes, when everyone else is flooded with excitement or fear, these traders feel curious. One trader in the study, profitable through 2008's chaos, described it. When Lehman collapsed, my colleagues were screaming, panicking. I felt like I was watching a movie, interesting, worth analyzing, but not personal. His DNA test confirmed it, double warrior variant. His brain literally couldn't produce the same panic response. But here's what matters for you. The study found something else. Traders without the genetic advantage who survived had developed workarounds. They didn't change their genes, they changed their triggers. Type dopamine junkie. If big green candles make your heart race, if market moves feel personal, if winning makes you high and losing makes you sick, that's normal genetics, not trader genetics. The genetic elite don't feel less, they feel differently. Dopamine plays a bigger role in the motivation for the reward than in the actual reward itself. They get their hits from process, not profits. Think about it. What if you could train your brain to crave perfect execution regardless of outcome, following rules when it's hardest, identifying setups correctly, win or lose, honoring stop losses like victories? Stan Druckenmiller, not part of the study but tested privately, has the mutation. He describes trading as solving puzzles. Wins and losses are just data points. The puzzle is what matters. You can't change your DNA, but you can change your dopamine sources. Professional traders have rewired their reward systems. Brain scans show they process successful trades and perfect stop losses in the same neural region. What gives you a dopamine hit? The green P and L being right, or the craft itself? Your genetic reality check. Starting tomorrow, celebrate one perfect stop loss like you would a winning trade. Share it, journal it, feel proud of it. Train your brain that discipline delivers dopamine. But even perfect genetics won't save you from the next trap. Insight number 7, the strategy hopping syndrome. The turtle traders were given the exact same rules. 13 became millionaires, 10 blew up. Same system, different brains. Richard Dennis wants to prove trading can be taught. He recruits 23 people, gives them exact rules. The turtle trading system. Simple trend following. Clear entries, exits, position sizing. No interpretation needed. The results should have been similar. They weren't even close. Curtis Faith, the youngest turtle at 19, made $31.5 million. He followed the rules through 11 straight losses, 22% drawdown, never wavered. Another turtle, with the same rules, same capital, same markets, lost everything in 3 months. The postmortem revealed why. He couldn't stick to one system. Loss. Endidispeaks. 1. Maybe I misunderstood the rules. Loss 2. The markets have changed since Dennis created this. Loss 3. I'll just adjust the parameters slightly. Loss 5. Abandons the system entirely. This is strategy hopping syndrome. Your brain, especially if you have the novelty-seeking DRD4-7R gene variant, gets high from new strategies. You're not addicted to trading success. You're addicted to the search for success. Dennis later said, "The turtles who failed weren't dumb. They were human. Humans want to improve things. Markets punish improvement. They reward consistency." Modern data is even more damning. A study tracking 10,000 retail traders found the average trader tries 12 different strategies per year. The profitable 1%, they average 1.3 strategies. For years. Type the number of strategies you've tried this year. Include every system, indicator, guru method you've tested. Be honest. Here's the brutal truth. Every strategy works sometimes. No strategy works all the time. The difference between winners and losers isn't finding a better strategy. It's sticking with a good enough strategy through its drawdowns. Mark Minervini, who turned 30,000 into over 30 million, uses basically the same strategy he developed in the 1980s. I've refined it maybe 5% over 30 years. Consistency beats complexity. Your brain will fight this. It wants novelty. It wants to feel smart. It wants the dopamine hit of discovering something new. That's not trading. That's gambling with extra steps. The cure is commitment. Choose one approach. Define its rules precisely. Track 100 trades minimum before even thinking about changes. Your edge isn't in the perfect strategy. It's in perfect execution of an imperfect strategy. What if success isn't about finding a better system? What if it's about becoming better at the system you have? Strategy hopping kills accounts slowly. The next insight shows how success can kill them quickly. Insight number 8. The Plateau Trap. LTCM's Nobel Prize winners averaged 40% returns for 4 years. Then they lost $4.6 billion in 4 weeks. Success was their destruction. The Plateau Trap is insidious because it feels like progress. Small, consistent wins, growing confidence, expanding comfort zone, then sudden catastrophic failure. Long-term capital management was the perfect case study. Founded by John Meriwether, staffed with Nobel laureates Myron Scholes and Robert Merton, the smartest guys in any room. Year 1, 21% return, respectable. Year 2, 43% return, exceptional. Year 3, 41% return, consistent. Year 4, 17% return in 5 months. Then, August 1998 happened. But here's what the news didn't report. Internal memos show the real killer wasn't Russia defaulting. It was the Plateau Trap. 4 years of success had rewired their brains. Risk models that screamed danger were overruled. Position sizes that once seemed insane felt conservative. Leverage of 25 to 1 became 250 to 1. Partner Victor Hagani later admitted, "We confused a good run with genius. Every month of profits made us feel more invincible. By year 4, we weren't trading markets. We were trading our own mythology." The Plateau Trap has 3 stages. Competence, you develop real skill. Confidence, success reinforces your methods. Complacency, your brain stops questioning. Stage 3 is lethal. Your prefrontal cortex, exhausted from years of vigilance, takes a vacation. You stop checking your blind spots. Stop questioning your assumptions. Stop respecting the market. After your best month ever, what happens next month? Comment bigger if you size up. Comment careful if you size down. Comment same if nothing changes. The data is terrifying. Traders who have 6 straight winning months have an 82% chance of a major loss in month 7. Not because they get worse, because they feel invincible. Paul Tudor Jones knows this. His famous quote, "I'm always thinking about losing money as opposed to making money." This isn't pessimism, it's plateau prevention. After his best periods, he deliberately shrinks. Smaller positions, tighter stops. Assume the worst. When I feel like a genius, that's when I'm most dangerous to myself. The antidote is systematic humility. Scheduled reality checks. Position size limits that decrease with success, not increase. Treat winning streaks like loaded weapons. Useful, but dangerous. Your plateau trap warning: if you've had 3 winning months, you're entering the danger zone. Your brain is rewiring for overconfidence. What safeguards will you install before it's too late? The plateau trap seduces you with success. The next trap seduces you with chaos. Insight number 9. The news gambling trap. News trading isn't trading. It's Russian roulette with spreadsheets. January 15th, 2015, 3:30 a.m. New York time. The Swiss National Bank announces they're removing the EUR-CHF floor. What happened next destroyed thousands of accounts in under 4 minutes. The franc moved 30% instantly. 30% in a major currency in seconds. Retail traders positioned for easy money saw this. 3:29 a.m. account value 50,000. 3:33 a.m. account value negative 170,000. Yes, negative. They didn't just lose their money, they owed their broker 170,000. FXCM alone reported 225 million in client negative balances. Alperi UK went bankrupt. Retail traders received legal notices demanding payment for losses exceeding their entire net worth. But here's what's crucial. Every one of these traders thought they were smart. The EUR-CHF floor was guaranteed by the Swiss National Bank. Free money? Until it wasn't. Type your biggest news trading loss. Just the number. If you've never traded news, type SMART. During major news, your analytical brain goes offline. Data shows win rates during NFP and FOMC plummet to 35%. You're not trading news. You're feeding your brain's need for chaos. Your brain on news releases is your brain on cocaine. Same regions activate, same dopamine flood, same inevitable crash. The only difference? Cocaine is cheaper. Here's what happens in your brain during NFP. Minus 60 seconds, anticipation. Cortisol rising, minus 30 seconds, adrenaline spike, hands shaking, release, dopamine explosion, time distortion. Plus 30 seconds, cognitive blindness, can't process. Plus 5 minutes, exhaustion, regret, confusion. Professional news traders don't trade the news. They trade the reaction to the reaction. Tom Dante, legendary Forex trader, waits minimum 30 minutes after any release. Let the addicts blow up first, then trade the exhaustion. The data is undeniable. Retail traders who avoid news completely outperform news traders by 340% annually. It's not about missing opportunities. It's about avoiding guaranteed destruction. But your brain doesn't want to hear this. It wants the action, the excitement, the possibility of instant riches. That's not trading. That's gambling with a Bloomberg terminal. What if news releases became your scheduled break time? What if you treated high volatility like a tornado? Something to shelter from, not chase. Your news trading audit: calculate every penny made or lost on news trades. Include the revenge trades after, the FOMO entries. Is it profitable or expensive entertainment? News trading feeds chaos addiction. The next trap feeds a different addiction entirely. Insight number 10. The stop-loss psychology. Traders who've never let a stop-loss hit are 500% more likely to blow their accounts. Paul Tudor Jones has a saying, "Losers average losers." But the psychology behind why traders can't take losses goes deeper than ego. It's about neural wiring. Jesse Livermore learned this through pain. His early career was marked by an inability to take losses. He'd move stops, delete them. Add to losers. His first bankruptcy came from one trade he couldn't admit was wrong. But Livermore evolved. By his peak, he was famous for hair trigger stops. He'd enter with 10,000 shares and exit with a 10-cent loss if it moved against him. $1,000 loss. Next trade. A reporter asked why he took such quick losses. His response: "I can always get back in. I can't always get my money back." This evolution from stop-loss hater to stop-loss lover is what separates the 99% from the 1%. But most never make the transition. Berkeley research revealed why. Brain scans show amateur traders process stop-losses in the same region as physical pain. Professional traders, they process stop-losses in the reward center, same as winning trades. How many stop-losses have you moved this month? Type the number. If it's above 0, you're trading with an amateur's brain. Mike Bellafiore from SMB Capital tells this story about every new trader. They come in disciplined, But they have a secret. They've never actually let a stop hit. Their discipline is just good luck. First real stop loss approaching. The excuses begin. News in 20 minutes. This is just a shakeout. I'll give it more room. They move the stop. Disaster follows. Not always immediately. Sometimes it works, which is worse. Now they've trained their brain that stops are negotiable. The professional mindset is radically different. They celebrate stop losses. Literally. Linda Raschke posts her stop outs with pride. Perfect execution. Saved 3% by honoring my stop. To her, a stop loss isn't failure. It's data purchase. She paid a small price to learn the trade was wrong. Without that data, she might have paid a large price. Think about it. A stop loss is just admitting you're wrong for a small fee. Moving a stop is insisting you're right for a large fee. Which trader survives long term? Your stop loss revolution starts now. Your next clean stop loss, share it like a winning trade. Feel proud. You just did what 90% of traders can't. You admitted you were wrong cheaply. Stop losses reveal character. Demo trading reveals even more. You understand the problems. You know why your brain betrays you. Now discover your path from the 99% to the 1%. These final insights show you how to evolve. Insight number 11. The demo to live shock. Same person, same strategy. 68% win rate in demo, 31% in live trading. The cruelest joke in trading. Demo success predicts live failure. The better you do in demo, the harder you'll fall in live. Northwestern University proved why. Different money, different brain. Every prop firm sees this pattern. SMB Capital's data is typical. Demo phase. New traders average 65% win, rate week 1, live, 45% win, rate month 1, live, 31% win, rate month 3, live, 90% washout. Same people, same setups, same markets, different results. Why? Brain scans reveal the shocking truth. Demo trading activates your logical centers. Live trading with real money? It activates survival circuits that predate language. You're not the same person anymore. One trader's journey documented in detail. 6 months demo, 10,000 to 47,000. Consistent, mechanical, confident. Day 1, live with 10,000 real dollars. Can't pull the trigger. When he finally does, position size is 1/10 of demo. Wins feel tiny, losses feel massive. Week 1, up $100. In demo, would be up 2,000. But this 100 feels monumental. He starts over trading to make real money. Week 2, first real loss, $500. In demo, meaningless. In live, chest pain, literal physical pain. That's groceries, that's rent, that's real life evaporating. Month 1, account at 7,800. Not from bad trades, from scared trades. Late entries, early exits, moved stops, death by fear. Who here crushed demo but struggled live? Type me. You're about to learn why this is biology, not psychology. Real money activates your amygdala, the fear center. This hijacks your prefrontal cortex. You can't think clearly because you're not designed to. Your brain treats financial loss like physical threat. It's to use it correctly. Demo is for testing systems, not building confidence. Real confidence only comes from real losses with real money. Start live with amounts so small they bore you. $10 trades, $20 trades. Build your real money neural pathways slowly. Your brain needs to learn that financial loss won't kill you. Professional traders know this. They fund new traders with tiny amounts first, not to limit losses, to build proper neural patterns. Only when you can trade $100 like demo can you trade 1,000. Only when you can trade 1,000 like demo can you trade 10,000. What if you started over? Not with your strategy, but with your psychology. What if you built your live trading brain as carefully as you built your system? Demo trading reveals one gap, the next reveals another. Insight number 12, the time frame confusion. George Soros said, "I only have one time frame, the right one." Most traders have 5 time frames, all wrong ones. Checking multiple time frames doesn't make you thorough. It makes you schizophrenic. Each time frame activates different neural circuits. Your brain literally can't process conflicting signals. It just picks the one that confirms what you want. Eye tracking studies at the University of Chicago prove it. Traders looking at multiple time frames don't analyze. they cherry pick. Their eyes spend 73% more time on time frames that support their bias. Here's what happens in every trading room, every day. A trader sees a perfect daily setup. Clear trend, clean structure, about to enter. Then the doubt, better check multiple time frames. 4 hour, confirms the daily. Good. 1 hour, sideways. 15-minute, complete opposite signal. 5-minute, chaos. Now their brain is broken. 5 different stories playing simultaneously. The original edge on the daily is forgotten. Analysis paralysis sets in. Hours later, the daily setup plays out perfectly without them. 300 pips missed because they wanted to be thorough. How many time frames are open on your screen right now? Count them. Type the number. If it's more than 2, you're sabotaging yourself. Paul Tudor Jones trades 1 time frame. Period. I found my edge on the daily chart in 1987. Still using it. Why would I confuse myself with noise? George Soros was more philosophical. The market has many time frames, but only one truth. Find the time frame that shows truth most clearly. Ignore the rest. Professional traders have a saying, 1 time frame, 1 story, 1 decision. They understand something neuroscience proves. The human brain evolved for single-threaded thinking. Multitasking is a myth. Multi-time frame analysis is worse. Your brain, faced with conflicting signals, doesn't average them. It picks the one that confirms your emotional bias. Always. You think you're being analytical. You're being manipulated by your own mind. The solution is radical simplicity. Pick 1 time frame. Master it completely. Know its rhythms, its fake-outs, its personality. Other time frames aren't confirmation, they're confusion. What if mastery of one beat mediocrity at many? What if depth beat breadth? What if simplicity beat complexity? Your time frame challenge. Trade only your primary time frame for 30 days. No peeking at others. Watch what happens to your clarity and your results. Time frame confusion comes from trying to see everything. The next trap comes from trying to be someone else. Insight number 13. The mentor mirage. Why do 90% of people who buy trading courses fail? It's not the course, it's the copying. Timothy Sykes starts posting every trade, complete transparency, exact entries, exits, reasoning. Thousands buy his alert service. The results? 5% make money, 95% lose. Same alerts, same stocks, same timing. One subscriber, Michael Good, turns a 1,500 into 1 million. Another subscriber, same period, loses 50,000. They're receiving identical information. What's different? Good understood something the losers didn't. You can't trade someone else's personality. He took Sykes' patterns and adapted them. Different position sizing for his risk tolerance. Different times for his schedule. Different exits for his psychology. The losers? They tried to be Sykes, trade exactly like him. Same size relative to account, same holding periods, same everything. It's like wearing someone else's prescription glasses and wondering why you can't see. The turtle traders proved this decades earlier. Richard Dennis gave 23 people the exact same rules, not guidelines, rules. Precise entry signals, exact position sizing, clear exits. 13 became millionaires, 10 blew up. The difference? The successful ones translated the rules through their personality. They followed the system, but traded like themselves. The failures tried to trade like Dennis. Same actions, wrong person. Have you ever bought a course or signal service? Type yes or no. If yes, did you try to copy exactly or adapt to your style? Your brain isn't wired like your mentors. Different genetics, different fears, different life experiences. Copying someone else's trading is like trying to copy their walk. You can mimic the movements, but it'll never feel natural. Mirror neurons make us think we can copy success, but trading success requires personal neural pathways, not borrowed ones. You need your own relationship with risk, your own pattern recognition, your own emotional management. Ray Dalio learned this early. He studied every great trader, tried to copy them, failed miserably. I was a bad version of them instead of a good version of me. His breakthrough came when he stopped copying and started translating. Take the principle, not the practice. Understand why something works, then apply it your way. The mentor mirage is seductive. Someone else has figured it out. Just copy them. But that's not how brains work. That's not how success works. What if instead of trying to trade like your hero, You learned from your hero how to trade like yourself. What if the goal wasn't to copy, but to discover? Your evolution requires you to stop being a bad copy and start being a good original. But first, you need to make trading real. Insight number 14. The withdrawal psychology. Traders who never withdraw profits have already lost. They just don't know it yet. Two brothers in Australia. Same starting capital, $5,000. Same strategy, same mentor. One crucial difference changed everything. Brother A. Never withdraw, compound forever. Think big. Brother B. Withdraw 50% of profits monthly. Trading must pay me. Year 1 results. Brother A. Account at $25,000. Never withdrawn a penny. Brother B. Account at $12,000. Withdrawn $11,000. Brother A mocks his sibling. You're killing your compound growth. That $11,000 could be $50,000 next year. Brother B shows his new car. Paid cash. This is real. Your numbers are pixels. Year 2, month 6, crypto flash crash. Brother A sees his $45,000 become $8,000 in one day. The psychological damage is severe. 2 years of work, gone. He enters depression, stops trading. Brother B takes the same percentage hit. Account drops to $4,000, but he's withdrawn $27,000 over 2 years, still up $23,000 overall. He keeps trading. Today, Brother A works a corporate job, bitter about markets. Brother B trades full-time. His withdrawals bought a life that supports his trading. His trading supports his life. Have you ever bought anything with trading profits? Type yes or no. If no, you're playing a video game, not building wealth. Never withdrawing creates dangerous psychology. Nothing feels real. Wins don't satisfy because they're just numbers. Losses don't teach because they're just pixels moving. Data shows traders who never withdraw treat accounts as play money. They take 250% more risk. Their brains never connect pixels on screen to purchasing power in reality. Mark Douglas understood this. He forced his students to withdraw monthly. If your trading can't buy a coffee, you're not a trader. You're a gambler with a spreadsheet. The brain needs tangible feedback loops. When trading profits buy actual items, neural pathways strengthen between good trading and life improvement. The abstract becomes concrete. Professional prop traders have mandatory withdrawal schedules, not optional, required, because firms know that traders who don't withdraw eventually blow up. They need to feel the reality of their success. What changes when you buy your first meal with trading profits? Your first bill? Your first vacation? Everything. Because now it's not a game, it's a profession. Your withdrawal challenge. Next profitable month, withdraw something, anything. $50, $500. Make trading pay you. Feel the difference between pixels and prosperity. But where does this all lead? What's the end game of this journey? Insight number 15. The evolution ladder. Your trading journey has 5 predictable stages. 90% quit at stage 2. Every successful trader climbs the same ladder. The stages are as predictable as human development. You can't skip them. You can only climb them. Most don't know they exist. Stage 1, lottery. Larry, trading is easy. I made 50% last month. Still drunk on beginner's luck. Thinks they've discovered something everyone else missed. Greed for quick riches. 90% fail here within 6 months. Stage 2, break even. Betty, I just want my money back. Reality is hit. Hard. They've lost money. Seen the dark side. Now desperately trying to recover. Greed for survival. 70% quit here. Stage 3, consistent. Carl, 2% per month. Every month. Boring, but beautiful. The first taste of real trading. Discovered discipline. Found an edge. Greed for consistency. 50% make it past here. Stage 4, longevity. Linda, I don't trade for money anymore. I trade because I can't imagine not trading. Trading becomes meditation. Money is a byproduct. Greed for the process itself. 10% reach here. Stage 5, master. Mike, everything you're chasing is wrong. Chase mastery. Money follows mastery. Complete transformation. Trading is art. Ego dissolved. Only 1% achieve this. Which stage are you in? Be brutally honest. Type 1, 2, 3, 4, or 5. No judgment, just truth. The evolution isn't about time. Lottery Larry could trade for 10 years and never leave stage 1. It's about identity death and rebirth. Each transition requires killing the previous version of yourself. Kill lottery. Larry's need for excitement. Kill break-even Betty's desperation. Kill consistent Carl's attachment to results. Kill longevity Linda's identity as a trader. Become Master Mike's empty vessel. The cruelest part? You can't skip stages, like trying to run before walking. Each stage teaches required lessons for the next. Paul Tudor Jones describes his evolution. Stage 1, I was gambling. Stage 2, surviving. Stage 3, I found discipline. Stage 4, I found myself. Stage 5, I found that myself was the problem. Most traders think success means moving from stage 1 to stage 5 instantly. That's not evolution, that's fantasy. Real evolution is messier, slower, essential. What if you accepted your current stage? What if instead of pretending to be stage 5, you focused on graduating from where you actually are? The market will exist tomorrow, and the day after, and the decade after. There's no rush except the one in your mind. Evolution takes the time it takes. You've just discovered the 15 neural secrets that explain every loss you've ever taken. From the biological trading clock that shows why your worst trades happen at specific times, to the evolution ladder that maps exactly where you are on your journey. From the dopamine genetics revealing why some traders are wired for success, to the withdrawal psychology that separates video game players from professionals. These aren't just theories. They're neural realities backed by MIT research, Wall Street genetics studies, and the blown accounts of millions who came before you. Here's my challenge. In the comments below, tell me which one insight hit you the hardest, which mirror moment made you see yourself differently. But more importantly, what are you going to do about it? Because knowing changes nothing, doing changes everything. Your 3 action steps. First, download the Greed Audit Checklist in the description. 15 questions that reveal exactly where greed is sabotaging your trading. Second, share this video with one trader who needs to hear it. Their account and sanity will thank you. Third, pick one insight from today and implement it tomorrow. Just one. Master it before moving to the next. Remember, greed built every fortune and destroyed every gambler. The only difference was direction. You now know the neuroscience. You understand the patterns. You have the blueprint. The market opens in a few hours. The same market that destroyed the old you is about to meet the neurologically upgraded you. Will you trade differently? Will you finally redirect your greed from outcomes to process? Your evolution starts with the next trade. Welcome to the 1%.